Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So now in this video I'm going to do the problem number 15. So far 14 main problems I have completed on the topic of depreciation. Before that, so many short bits and MCQs I have completed on depreciation. So if you want the complete command, watch all the videos from the beginning till the end. Don't skip in between. If you want the complete command knowledge on this topic of depreciation. Now, before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep ready the printout before start watching the video, because without problems you cannot be able to understand the solution. Take a screenshot of the solution of problem number 15. Then I explain all the points in detail. Come on, see the 15th one. Deepak is a manufacturer. His financial year ends on 30th November. That means every year he closes the accounts on 30th November. Deepak depreciates all his non-current assets at the end of each year. Required. Explain how providing for depreciation of non-current asset is an application of the principle of prudence. There are different accounting concepts like money measurement concept, business entity concept, dual aspect concept, accrual concept, realization concept, prudence concept. So what the prudence principle says? The prudence principle says that accounts, that means the income should not be overstated. Assets should not be overstated. That is the principle of prudence. So this depreciation is an application of the principle of prudence. Why? Because when we provide the depreciation, the profit will not be overstated. When we provide depreciation, assets will not be overstated. Suppose if we do not charge depreciation, the profit will be overstated. If we do not calculate depreciation, the assets will be overstated. So by using this depreciation, the income and also the assets are not overstated. That will comply with the provision principle of prudence. So here the answer is ensures that the profit for the year is not overstated in the income statement. That means by charging this depreciation, the profit will not be overstated. Similarly, ensures that the non-current assets are not overstated in the statement of financial position. In the statement of financial position, we will find non-current assets. So if we provide the depreciation, it will not be overstated. Non-current asset will not be overstated. That is the answer for the first A bit. Now, Deepak depreciates his motor vehicles using the reducing balance method 20% per annum on all the motor vehicles held at the end of each financial year. Simply, the method of debt is reducing balance method 20%. No depreciation is charged in the year of disposal. As usual, every problem there is an assumption that full depreciation should be charged in the year of purchase and no depreciation in the year of sale. On 1st December 2015, Deepak owned motor vehicle A, which had cost $40,000 and had been depreciated by $14,400. So remember the date. 1st December 2015, he is already having a motor vehicle A whose cost is 40,000 and accumulated depreciation on this motor vehicle A is 14,400. On 1st August 2016, Deepak purchased motor vehicle B on credit from ZY Motors for $50,000. So two motor vehicle he is having. First motor vehicle existing A motor vehicle, its value is 40,000 and accumulated depreciation on this motor vehicle A is 14,400. And on 1st August 2016, he purchased another motor vehicle B at a cost of $50,000 on credit from the supplier ZY Motors. That's it. This is the complete story of the problem. Now requirement. What is required? Prepare a journal entry to record the purchase of motor vehicle B. It is asking you what is the journal entry to be passed when we purchase a motor vehicle B from ZY Motors. From ZY Motors on credit. So journal entry. When we purchase motor vehicle is coming in. Debit what comes in. So motor vehicle debit. What is the amount? 50,000. Motor vehicle B debit 50,000. And whose account is created? The supplier. Supplier is ZY Motors. ZY Motors credit 50,000. Journal entry. Motor vehicle debit 50,000. ZY Motors credit 50,000. B question completed. C bit. Calculate the depreciation on motor vehicle A for each of the 2 years ended 30th November 2016 and 30th November 2017. We are required to calculate depreciation for 2 years on motor vehicle A. The method of depreciation is reducing balance method and rate of depreciation is 20%. Vehicle A. What is the cost of motor vehicle A on 1st December 2015? Date is given 1st December 2015. Its cost is 40,000. On the same date, the accumulated depreciation on this motor vehicle A is 14,400. So deduct 14,400, book value at 1st December is 25,600. This is the book value. Now first year ends up to 30th November 2016. Next year, 30th November 2016, the depreciation is to be provided at 20% on the carrying value. What is the book value? 25,600. So 25,600 into 20 by 100, 5,120 is the depreciation. Deduct depreciation 20,480. This is the book value. Now calculate depreciation for the next year, 30th November 2017, sorry. 16 over, now 17. So 20,480 into 20 by 100, 4096 is the depreciation. Deduct depreciation 16,384. This is the book value on 30th November 2017 or 1st December 2017 we can say. So this is the calculation of depreciation on motor vehicle A for 2 years, that is 16 and 17. That's it. So C bit completed. Now D bit. Calculate the depreciation on motor vehicle B for each of the 2 years, 30th November 2016 and 30th November 2017. When it is purchased, August 2016, this motor B is purchased. And remember, whenever motor vehicle is purchased, we will provide the depreciation for the full year, irrespective of the period of holding. Here it is purchased on 1st August 2016. Cost on 1st August 2016, 50,000. We are closing the accounts on 30th November. August के बाद September, October, November, 3 months. So depreciation up to 30th November. So 50,000 into 20 by 100, 10,000. Deduct 10,000, 40,000 is the book value. Next year, 30th November 2017, 16 completed, now 17. So 40,000 into 20 by 100, 8,000. Deduct 32,000. This is the calculation of depreciation on motor vehicle B, which is purchased. Next, E bit. Prepare the journal entry to record the transfer to the income statement of the total depreciation on motor vehicles for the year ended 30th November 2017. How much total depreciation that will be transferred to income statement? The entry for charging depreciation is income statement debit, provision for depreciation credit. This is the entry. But we need the total depreciation on vehicle A and vehicle B. So what is the depreciation on vehicle A? Here we have calculated 4096. 4096 is the depreciation for the year ended 30th November 2017. 30th November 2017, depreciation on A vehicle 4096. What is the depreciation on B vehicle on 30th November 2017? Here 8,000. 8,000 is the dep on B. and 4096 is the dep on A for 31st December 2017. So total depreciation 4096 plus 8000, 12,096 is the depreciation. Income statement debit and provision for depreciation credit. Income statement debit, provision for depreciation credit. This is the entry for charging depreciation. EBIT completed. Now F. Calculate the total depreciation provided on motor vehicle A up to the date of disposal. What is the total depreciation we have provided on motor vehicle A at the time of disposal? So we can calculate here. Already we have calculated motor vehicle A. What is the depreciation up to 1st December 2015? 14,400. Next, what is the depreciation up to 16? 5,120. What is the depreciation up to 30? Up to 17? 4096. So 3 depreciation are there. At 1st December already 14,400 is there. And 16 it is 5,120. 17 it is 4096. Add up the 3. So calculation of total depreciation provided on motor vehicle A up to the date of disposal. So up to 30th November 2015, this one, 14,400. Up to 30th November 2016, 5,120. Up to 30th November 2017, 4096. Total depreciation is 23,660. 23,660 is the total depreciation provided on motor vehicle A up to the date of disposal. Next, last G bit. Prepare the journal entries to record the transfer of original cost of motor vehicle A to the asset account. See here, whenever an asset is sold, the original cost of the asset will be transferred to a new account called asset disposal account. A new account will be opened. Asset disposal account. Here we have motor vehicle. The motor vehicle disposal account. What is the entry for transferring the original cost to asset disposal account? Entry will be motor vehicle disposal account debit and motor vehicle account credit. That is the entry. So here transfer of original cost of motor vehicle A from the asset account. So disposal account will be debited, motor vehicle account will be credited. So disposal of motor vehicle account debit 40,000, motor vehicle account credit 40,000. This is the entry for transferring the original cost to disposal. Last and final entry we have to pass, the transfer of accumulated depreciation on motor vehicle A from the provision of depreciation account. Second entry, the total depreciation provided on that motor vehicle which is sold. Which motor vehicle is sold? A motor vehicle is sold. What is the total depreciation provided on A motor vehicle? 23,616. This 23,616 should be transferred to asset disposal account. The entry is provision for depreciation account debit, provision for depreciation account debit, and asset disposal account credit. Asset means motor vehicle. Motor vehicle disposal account credit. So entry is here. Provision for depreciation account debit and disposal of motor vehicle account credit. 23,660. That's it. So simply entries it is asking. That's all. So in this chapter of depreciation, not only making the accounts and calculating depreciation, but also you must remember the journal entries. What are the journal entries at different circumstances? When we purchase the asset, when we charge the depreciation, when the asset is sold, you must remember. So this is the end of problem number 15. Inshallah, the next problem, 16th one, will continue in the next video.